if in 10 years we've not acted materially on climate, then we are all in trouble. Like, it's kind of run for the hills, get your guns and your land sort of time, like societal breakdown. You need to remove billions of tons a year of CO2 from the air to get back to the kind of atmospheric CO2 concentration that like allows us to have a manageable degree of warming. To get to net zero, we need to scale up to about 5 gigatons a year of removal, so 10 times as much, but do that in a quarter of the time. That is insane. Net zero is a really bad plan because it involves like massively overshooting boundaries of the ecosphere and then clawing that back by removing billions of tons of carbon. Right, this is a bad solution. We should have started decarbonising 2-3 decades before, and then we wouldn't need the removal part.
What's the role Sylvera is playing?
We just need that meter reading that people trust, and that's where we started. It's just like, need to be able to homogenize it. You need a trusted third party that says we're going to weigh the impact of this credit, of this claim, and then we're going to obsess about the accuracy of that measurement. That's all we're going to do, is just like do that thing.
Welcome to the Climate Insiders podcast, where top climate thinkers, entrepreneurs, and investors share revolutionary ideas and insights. Tune in to learn from the visionaries shaping a sustainable future. Let's dive in. Allister, welcome to Climate Insiders.
Thanks for having me.
It's great to have you representing Sylvera. So Sylvera is one of the leading carbon data providers out there. Your mission is to incentivize investment in real climate action. How do you make this happen?
Indeed. So it's quite the mission. Yeah. What we do at Sylvera, we provide end-to-end solutions for procurement of carbon instruments and investment in carbon projects. So behind that, expertise, data and tools to help people do those things, put their dollars to work in service of climate action. So that's us.
And to get this straight, how do you defer to organizations like Verra or B0?
So we are well known for rating carbon instruments. That there's very different what Verra and B0 do, but I think to go there, you've kind of got to go 2 steps back.
Mm-hmm. Let's go there.
Okay, let's go there. Right. So, is it worth for the audience restating why bother with all this carbon? Carbon credits. It just seems too controversial, too messy. Why is anyone doing it? Is it worth just restating that?
It's worth uncovering why carbon markets are so important, and we're going to go about the dark side of carbon markets that has been kind of overly used and misattributed. But please. Yeah, you can plant some seeds.
So the foundation for all this is we have emitted much too much CO2 into the atmosphere. Mm-hmm. It's causing climate change. There's like a plan B for dealing with that called net zero. Net zero is a really bad plan. It's like, that's why I'd say it's a plan B. It's more like a plan D or E or something. Because it involves like massively overshooting the boundaries, like the planetary boundaries, like the sustainable boundaries of the ecosphere, and then clawing that back by removing billions of tons of carbon. Right. So this is a bad solution. But the kind of 2 main facets of the plan is reduce our emissions down 80-90%. Mostly that's going to be electrification, but there's a lot of land emissions, transport emissions, like aviation, that might be difficult to electrify. And then you need to remove billions of tons a year of CO2 from the air to get back to the kind of atmospheric CO2 concentration that like allows us to have a manageable degree of warming. The reason why I'm kind of saying it's not sensible, we should have started decarbonising 2-3 decades before, and then we wouldn't need the removal part. The removal is going to be very, very expensive. And the way I would normally people talk about CDR and, we need that stuff. We have to now. There's no option. There's no plan F. We're just on the last plan right now. If you compare it with the growth of another sector, and then you can kind of see how big that growth in carbon removal needs to be. And the analogy that I would use is the oil industry. So boom times, you've just invented mechanical oil drilling. It's the 1860s. To get to half a gigaton of oil production, of crude oil production a year, that took nearly a century. but we are going to over 90 years. To get to net zero, we need to scale up to about 5 gigatons a year of removal, so 10 times as much, but do that in a quarter of the time. So that is insane. Like, that's the plan. That's what we're doing. Everyone's agreed to that. And at the same time, there's a multi-trillion-dollar a year funding gap for that electrification and all of that stuff. So on the reduction of emissions side, so that's the work. That's our plan for the world, which is pretty depressing because people don't like paying for things, and that's a lot we've got to pay for, right? So where carbon instruments come in is basically a way of financing both of those sides of the equation. The reduction in emissions needs to be paid for, and the carbon removal needs to be paid for. And then the whole problem with this market, other than the fact that the credits have no obvious utility, like oil or electricity you can use to do something, right? Carbon instruments, carbon credits, they don't do anything, right? They're an accounting metric that you're not, unless you're forced to buy that, why would you spend money? So that's a huge problem. But the kind of first problem to answer is like, unlike oil, unlike grain, unlike any commodity, you don't physically receive the tons of carbon. Like, the point is it's supposed to be injected under the sea, or like the biomass is underground, or it's in a forest. Like, I don't take physical receipt of it, so I can't inspect it. I can't test it.
It's invisible.
Yeah. And if you even think about like conventional commodities markets, Trafigura is one of the biggest trading businesses. They lost hundreds of millions of dollars buying rocks that were supposed to be nickel, and they never tested the rocks. So you get all of this. There's a strong incentive if you're just you're delivering a paper ticket to say, hey, it's all fine. Like, the stuff's there. Like, don't worry. That forest's there. That activity happened. It says so on this ticket, right? And unfortunately, that incentive and the lack of regulatory action, of legal action, of criminal penalty means that you're always going to have a tendency to overstate the impact. And so you have these two problems. You can't test it reliably. There's no meter reading, and there's a strong incentive to overstate. And that's true of basically all carbon instruments, of like removals, avoidance, nature-based, engineered. Those two things are true in all the whole sector. So why Sylvera started was basically you need to homogenize that mess of different types. So because we're so late in the game, you need hundreds of different types of activity, like algae, reforestation, biochar. Like, you need to do everything all at once, and then you need to homogenize it. You need to be able to make them equivalent, and then you need to be able to test the claims. So that's kind of where we started. What Vera does is in fact, I'm just going to stop there because I'm just but that's the scene. That's the scene, and so we're kind of started being like, we just need that meter reading that people trust, and that's where we started. It was just like, you need to be able to homogenize it. You need a trusted third party that says, we're going to weigh the impact of this credit, of this claim, and then we're going to obsess about the accuracy of that measurement. That's all we're going to do, is just like do that thing.
I get it. So can you share a real world example of how Sylvera's ratings have influenced the company's decision to go on a different trajectory as they would otherwise?
Looking to make smart investments in climate tech? Subscribe to the Saturday Climate Insider newsletter. Every Saturday, I'll send you one actionable tip to navigate the climate tech investment landscape. Join over 3,500 investors who are already gaining exclusive insights and strategies. Subscribe today.
Ooh, that's a good one. Yeah, I mean, it's difficult to name names because of our, I don't want to put our customers in trouble. But like most buyers of carbon instruments are doing it under voluntary scheme. Well, actually, that's not true. Most of the money spent is under compliance schemes, but those so the EU ETS, there's a Chinese scheme. They're worth about $1 trillion. Those things are like true indulgences, is a permit to pollute. If I spend the money, I can put the CO2 in the air that's kind of the jobs. It puts a price on the carbon, and the incentive is to decarbonize, but it's a permit to pollute. When one of our clients would use a carbon instrument, it's to go above and beyond their own decarbonisation efforts. And they're typically doing that because they want to do the right thing. They're decarbonising, they're on the track towards that like 80-90% reduction. They're going to start ramping up so they set some net zero goal and then they're buying the credit. So typically, if they're going to spend the money, they want the climate impact to be real. Now, when we started, it was just starting to dawn on people that maybe the climate impact wasn't real, and then they started to want to test what was under the ticket that they were being sold, and we started doing that, and very quickly it was clear in many cases it wasn't true what was being claimed, the impact. So I can't name it, but I will name one afterwards. But we were working with a big brand name consulting business, and we were looking at their credits. We found some project it was such an egregious failure of all process that it was like we'd struck gold on the first strike kind of thing. And it's like, what are the odds of that kind of thing?
They are paying you to rate them, to make sure that they're true to what they're claiming, because they don't have the...
This was before we even had a rating scheme. We were just trying to evaluate them on these kind of principles, like that everyone shares. It has to be additional. It should be permanent. The accounting should have been done soundly. But this didn't even fail there. It failed the project was completely invalid under all of the methodology that it was under. This was under their methodology, and it got through the verification, had been done badly. And so the idea is this was a reforestation project. The idea with a reforestation project is the classic one would be, hey, this bit of the Amazon was deforested for beef production 40 years ago or something. The soil's been stripped so hard, it's been pushed so hard, it's not going to naturally regenerate. You're going to have to invest something, and then you're going to put ideally it would be back natural, the native species, and then you would put the land in trust. That'd be the perfect project. It'd be put in trust, and it should survive as long as there's enough rainfall. Nobody touches it. This project was in Thailand, and it had been deforested till the very last day before the project starts. So there was a beautiful natural forest been cut down. And then on the day there was no trees, then they started planting a rubber plantation. And it's like, oh my word, they wanted the rubber plantation because it was productive rubber producing land, and they'd just sold all the timber that was on that. This is the worst kind of, it's completely ineligible. The methodology, Vera methodology, does not allow that. It's not considered valid under even the Kyoto, the CDM standard, invalid, right? Not valid. And this was on the market for years, right? And we were the first people that pointed this big brand name consultancy, big brand name vendor, and we were like, oh my word, we found this straight. This is not a good sign. And so then they started cleaning up their portfolio, and then now one of their peers, and I can name it because they came out publicly, they basically, so BCG, they came out saying, yeah, all of the credits that we bought in the last year were BBB or above. So that would be, we'd consider an investment grade, same as a fixed income, BBB and above, Sylvera. And they'd moved all of their purchases onto those where you have a good degree of comfort that the impact being claimed is real, which is great, because then so we're trying to move ineffective spend towards effective spend, because that's our mission, real climate impact. And then by showing that it can be done, so by BCG being hey, look, we're decarbonising at this rate, we're doing all the things, scope 1, 2, and 3, we're on track. And now we're buying credits, we're investing in carbon removal, we're investing in emissions reductions to help the rest of the world decarbonise. And we're using Sylvera to make that come true, to make sure those investments are impactful. Then it shows other people they're like, oh, maybe I can do this, and it shows a role models. So it's kind of a theory of change element where you're trying to show that it can be done correctly.
What is a BBB in that ranking scale? Is that a good rating or is it a poor rating? And as opposed to BBB, what would be a AAA?
So triple B would be it mirrors fixed income rating, so like a bond. So a triple B would be like a investment grade bond that a pension fund might have, or like a bank could use as like a tier 1 capital against its regulatory requirements or something. And it basically means it's not likely to go bust. And triple B would be like, the claim is true. There may be some risks that something might go wrong in the future, but you have a reasonable expectation that the claim is true. Triple A would be like, you have a very strong expectation, like extremely strong, that the claim is true. The accounting probably has some degree of like conservatism. So something could go wrong and it would still be considered, they may have sold 1,000 tons, they could have sold 1,500 tons, but they've put a buffer in their own project. They didn't have to do that. Could be something like that. It would be very, very permanent. So you would need like a very high degree of durability, like it's out of the atmosphere, like for 1,000 years. That would be required for a AAA. And all those we show subscores for those factors as well, so people can kind of choose their own portfolio construction. But we typically find that most of the folk who want to create products, they will use a triple B threshold or an A threshold. So there's a contract that you can trade on the ACX exchange, and it's SAN. It's called Sylvera A Nature. So you can say, I'll have a ton of SAN, and anything can be delivered into that has a Sylvera A rating. It's a nature-based credit with a Sylvera A rating.
Now, to get a sense of rating, how would you rate something like DAC, direct capture?
So the question is, I guess, like, what would it, on the things that people care about, what would it score on? And the thing is what you see is you can't go by type, you have to go by project, because different types of activity have different characteristics.
Let's pick Climeworks.
Climeworks is probably a good example. It's expensive, right? And think like Climeworks credits are expensive, but you can't. Right now, we can't rate them because they don't sit under a methodology like Vera currently. So there's no standard disclosure or reporting. But the things that you would, which is not a good thing, to be clear, that doesn't exist for most CDR projects. There should be standardized disclosure reporting. Even when there's standardized disclosure reporting, you still get overstatements. So like when there's none, here be dragons kind of thing, definitely buyer beware. But like the things you would test for, and I think Climeworks is like unusually good among its peers on this stuff, is the accounting of the project being done correctly? Is the activity additional, and is the storage of the credits permanent? Now, in their case, the way they're locking down the credits, it should have a high degree of permanence because there's a rapid conversion of the CO2 is mineralized because of the techniques they use in those geologically active locations, like in Iceland. So on permanence, it's not going to leak out again, right? Great. Be there for 1,000 years. On additionality, like no one in their right mind would be doing that activity unless they were paid, because it's extremely expensive. So additionality, great. The question, and this is true of most CDR projects, is around the accounting. So, and this is why we can't, because you'd expect AAA straight away, right? Of course, right? But they are subject to the same kind of challenges in accounting and the ability to create misstatement as any project type. So just to be specific, let's say a facility does like 1 million tons of sequestration, let's say a year.
Which is far from the current projections.
Or 1,000 a year, let's say, it's more like that. Just to make the numbers easier, 1,000 a year. And let's say they said it was going to run for 20 years. So great, you'd say, great, you can sell 20,000 tons of credits over that lifetime, 1,000 a year. But that's not true. You can only sell the net sequestration. So you have to take off all of the energy costs from spinning the thing up, all the steel and cement and stuff, the commissioning emissions, and then all of the decommissioning emissions. So you need to. So let's say they might be like 4,000 for the commissioning and 1,000 for decommissioning, right? So now you're down to like 75% of the initial sum, so 15,000 of the 20. Then you've got all the energy costs. So the energy they're using geothermal, so it's very, very low emissions there. So that's great. Now you've got two slight problems here. Is that facility going to run for 20 years? And when are you going to start to sell the first credits? So like, let's say year one, I'm already inheriting 4,000 tons of emissions, right? Can I sell credits in year one? Like, or should I have paid the 4,000 off, right? Really, I should have paid the 4,000 off before I start to sell credits because I've just emitted 4,000 to build the thing, right? So like you get a poor disclosure around that. We don't know yet still what they've done. Then you have a question like, are you really going to run it for 20 years? So then this is a question about most of the CDR facilities, that operational period, again, it's unknown, nobody discloses it. And then there's a question like, are you going to run that prototype subscale 1,000-ton a year plant for 20 years? Of course you're not. This would be insane, right? It's going to be obsolete in 5 years. So then you're like, oh shit, well, if you're only going to run it for 5 years, you've not sequestered anything, right? So you probably
triple A becomes
a D. It's invalid, yeah. But like, I wouldn't say that's true of Climates, and I think Climeworks are unusually rigorous around their LCA, their life cycle analysis, their accounting, but we still haven't got the disclosure to be able to test their claims. And that's a problem. It's a problem for the whole industry. Like, it's a big problem. Like, an even bigger problem is, and I think actually, like, again, like Climeworks are probably right at the top there on the robustness of their work and their accounting, even though we haven't seen it, but just probably we get that impression. Let's say an even like more egregious kind of scammy case would be like, they've taken great trouble to site their facilities where you have a low carbon electricity baseload 24/7, right? It'd be way easier just to like put something on the grid in the US and just buy RECs to say, I'm running this off green power, but I'm just taking power off the grid. I don't want to have to worry about putting a solar plant with storage. I'm just going to take grid power. I'm going to buy renewable energy certificates to make my power green, to make the accounting work. Then you've just built a massive $1 billion REC laundering facility, right? You're taking cheap renewable energy credits in, and you're selling very expensive CDR credits out, but it's an accounting mechanism. It's not real. There's no additionality around RECs. So again, we don't know if anyone's doing that because nobody will tell us, right, which is not a good thing, right?
Now, if we're kind of zooming out, since you have an oversight on all the type of CDR and carbon capture or carbon removal technologies out there, what emerging technology or something that's already established as the highest grade, or would you say and invite more investors to invest in?
Enjoying the podcast? Make sure you don't miss an episode by subscribing to our YouTube channel. Click the subscribe button now and stay updated with the latest in climate innovation.
I mean, we're in an all of the above kind of situation. What we've always thought is like, and carbon markets are supposed to be good if you let them work well and they have good information, finding the marginally lowest cost solution. So if you're happy with 50, 100 years permanence, then, or the regulators are, or you, the buyer is, and they're happy with that, then the lowest marginal cost would be reforestation. Mm-hmm. If you need 500 year, 1,000 year, 200 year, it depends on the curve, the discount you apply, biochar, right? If you need 1,000 year plus, then it might be enhanced rock weathering. So at each level of permanence, there'll be a cheapest to deliver, and that's where you should invest, right? So if you're an investor, like, frankly, you want to be rational and go for the things that have the structurally lowest cost to supply. That, I'd say, is like thermodynamically unfavored. I don't know if you might have seen this in the press. I know a founder of a company called Fabric Nano. One of the problems with enhanced rock weathering, you crush this rock down to dust so that it basically is like a giant antacid. Like when it rains on the farmland where you put the dust, it kind of takes the CO2 out of the air. It takes 10, 20 years. they've designed a coating that goes on the powder. It takes it down to 2 years, right? So if you can use those technological improvements, you can radically improve. Now the question is like, what's the cost of the coating? But like, there are ways to. You just need to go after the fundamental cost structure, and it's always very much like renewables. It's like, what's the capex? The capital cost. What's the operational cost? The opex. What's the yield? What's the output per year for that spend? And then what's your cost of capital? So like, you should think about these things like renewables, but you then have to think about like, what is the use of that credit? So it's, you might be like, oh, I'm going to go long on Brazilian landscape restoration, but the EU might say, no, you can't use it here, but you might only be able to use it in the Japanese market. That's going to affect the price you're going to get. And the cash flows of that project. So you need to kind of model out those sort of the likely use cases for those credits, because that's going to set the price effectively.
And looking ahead in 10 years, which is a prediction game, which is speculation, but what do you envision for the future of the carbon markets, and what's your role in it? Are you the role of calling the shots, guiding capital, routing government's decision? What's the role Sylvera is playing, and are we going to be in a drastically different state?
Oh gosh, I mean, if we're not in a drastically different state, then we are all in trouble. Like, it's kind of run for the hills, get your guns and your land sort of time, like societal breakdown kind of. In fact,
within the next 10 years.
I know, as in you want to be preparing for that. If in 10 years we've not acted materially on climate, and definitely the removals comes into that. I was actually at an event in a New York Climate Week, full exec kind of level event, sort of C-suite, and I was being a little bit contentious, and I there's lots of big emitters in the room, and I was like, well, we'd say your default state as we're going is like societal collapse to some level, thinking that people are going to be like, who's this guy? Like, and people just nodded. And I was like, oh, that's even more scary. Like, I was expecting them to be like, screw you, no, we've got this covered. And people were like, no, yeah, basically that's broadly what we're tracking towards. And I was like, oh, I did not expect that reaction. But yeah, no, I wouldn't say with that.
What are they doing about it? So there's a consensus that there's societal collapse looming, and yet they're business as usual.
I would. So basically, the and again, actually, it came up on this on the agenda on this thing. Again, C-suite, major listed business, not FTSE 100, but like a S&P 100, like top 100 market cap business. And they were like, well, look, the question is, if we need to get to net zero, we need to the question we're asking on the board is, what level of margin dilution are we going to accept for that, or where are we going to calibrate? Like, and what margin dilution basically means is like, what's our profit margin going to be? How much money are we going to make? And literally, like, what's the value we're going to write down our business? So if they continue as they are, there's no cost of carbon, and the business will be valued at as soon as they start to take on a cost of carbon, the valuation of that business will be written down by hundreds of billions of dollars, right? So that's why they're also negative. And we work with asset managers as well. We work with like sovereign wealth asset managers worth like trillions of dollars. And it's kind of depressing, because it's basically like when they think about our asset allocation, they are like purely economically driven. So we're like, we expected them to be interested in the net zero status, like what types of credits people are using, how they're planning for that. And they're kind of like, no, we're interested in it, but we kind of don't care professionally, because we're required, our fiduciary duty is to manage the funds from a purely economic basis. Like, they have to, or they could be sued, or or fired, or both. So they have to purely manage that. So the flip side is like that business. Why should they spend, whatever the price is, $20, $50, $100, $1,000 per ton on their carbon emissions is why should they why should they do that? They're literally acting against their role as a corporate officer. They need to be regulated, so that they need to be forced, right, to do it, and then they will do it. So prediction for 10 years is like, you will have convergence between voluntary and compliance markets. Compliance markets right now are just pollution permits, but it doesn't fund carbon removal. It doesn't fund protection of forests and deforestation, which is required to get to net zero. It doesn't fund like agricultural transitions. So like what you're going to see is like a patchwork of local regulations where you're starting to force people to act. And you'll have all sorts of fun and games of people trying to play that and minimize the cost themselves. Some people will embrace it. Some people will kind of fight it. And typically the ones with the most to lose will kind of fight it, or they'll move their areas of operations. They'll divest of where they're going to be exposed to a higher carbon price. And so you'll see this kind of patchwork world. And as a result of that, like convergence and the forcing people to pay, you will see a huge carbon market. And you do need an effective measures of quality, so we'll play a role there. But we want that to be, there's trillions of dollars that have to be spent a year by then. So we want to maximize that number.
Is it going to be a regional fragmented market, and if so, which region is going to be ahead?
So to sum up, where are we going to be? Can we expect all the world's governments to agree and implement things that will put costs and change their tax revenues, and all to agree and synchronize within 10 years? I doubt it. What you will see is you will see cross-border relationships develop. You will see tax barriers like the CBAM being thrown up, and that will force some degree of global convergence at the margin. And you will see hundreds of billions of dollars being spent across the different Article 6 voluntary compliance markets. But remains to be seen whether the spending will be at the level that we need to tackle the climate crisis. That's the big question.
All right. With that, thank you so much, Allister, for coming on Climate Insiders.
Pleasure.
Hopefully, we will see how those speculations and projections unfold.
Indeed so.
And Sylvera can play a tremendous role there.
Thanks so much for having me.
Thank you very much.
Ready to make a substantial impact on our planet's future? Join the Climate Insiders community today. We are a group of investors committed to supporting bold, moonshot startups that are tackling climate change head-on. Become a part of a new generation of climate investors and help us create a sustainable future. Visit climateinsiders.com to join now.